Hello everyone, welcome back to my YouTube channel. In the last class, we studied about financial statements with adjustments. So, we learned about what is the adjustment of closing stock, outstanding expenses, prepaid expenses and accrued income, right? So today also I am going to continue this class only. So now our fourth adjustment, that is income received in advance. Income received in advance. It means what? The income received in advance, it means the income that is received for the next accounting year. Income that is received for the next accounting year. Clear? So what is the treatment? So that is deducted from income in the profit and loss account and shown as current liability in the balance sheet. Because why we need to deduct from the income in the profit and loss account? Because that is the income received for the next accounting year, not current accounting year. Clear? That's why we need to deduct from the income in the profit and loss account. And second one, it is shown as current liability in the balance sheet. Why? Because the income does not belong to the current year and the business, it has an obligation to provide the service in the future. So shown as current liability in the balance sheet. See, for example, a coaching center received rupees 30,000 as fees in March 2025 for classes to be conducted in April 2025. Means the coaching center, they are going to conduct the classes in April, but they received the amount of rupees 30,000 in March only. Means it means what? That is the income received in advance. Clear? So since the service is not yet provided, that is rupees 30,000 is income received in advance. Means if our accounting year till March 2025 means, so this amount of rupees 30,000, that is not related to that accounting year, because we are going to provide the service in the next accounting year, that is in April 2025. Means the amount of rupees 30,000, that is income received in advance. First, what we have to do, we need to deduct it from the income in the profit and loss account, and after that shown as current liability in the balance sheet. Because why? Because the coaching center, that has an obligation to provide the coaching or service in the future. Clear? So this is what income received in advance. So these are the treatment of income received in advance. Clear? Now next one, fifth one, it is depreciation. So let's see the depreciation. First, what is the meaning of depreciation? Depreciation, it is nothing but it is the gradual decrease in the value of fixed asset, that is due to usage or any passage of time. Clear? That is what depreciation. So this concept we have already learned, right? So depreciation, that is the gradual decrease in the value of fixed asset due to usage, passage of time, wear and tear, etc. Clear? Now let's see the treatment of depreciation. So before that, why we charge the depreciation? Because to show the true value of asset, right? And calculate the correct profit or loss. Clear? Now let's see the treatment of depreciation. So here depreciation, that is debited to the profit and loss account because it is an expense. Clear? Means that depreciation, that is in adjustment, that is related to the current accounting year. Clear? Depreciation, they are an adjustment because the depreciation, that is related to the current accounting year, because it is an expense. Means debited to the profit and loss account. Means these are the indirect expenses. Means they are not directly related in the production or manufacturing of goods or purchase of goods. Clear? So first we need to debit, and after that in balance sheet, means in the profit and loss account, directly we need to write down the depreciation value to depreciation. Clear? And in the balance sheet, what we have to do? Depreciation is deducted from the value of asset and shown on the asset side of the balance sheet. First, we need to deduct the depreciation amount from the value of asset, and after that shown on the asset side of the balance sheet. See the example. If the machinery is rupees 1 lakh and depreciation is 10%, the depreciation will be rupees 10,000. Means first in the profit and loss account we need to debit this amount of rupees 10,000 because it is an expense. Clear? And after that in the balance sheet we need to deduct this depreciation from the value of machinery, that is rupees 1 lakh. Means 1 lakh minus 10,000, that is rupees 90,000. So rupees 90,000, that is shown as in the balance sheet on the asset side of the balance sheet. Clear? Easy, right? Now next adjustment, that is for bad debts. Bad debts, it means what? So bad debts are the amount due from the debtors which are irrecoverable. Means they are not recoverable. That is, they cannot be collected. They are not collected from the customers. That is what bad debts. Clear? Now let's see the treatment of bad debts. See here, bad debts are debited to the profit and loss account because it is a loss to the business. Means these bad debts are an adjustment because the loss is related to the current accounting year. And bad debts, that is debited to the profit and loss account, means these are the indirect expenses like depreciation, means they are not directly related to the purchase, production or manufacturing of goods. So write down two bad debts and write down the amount of bad debts. But in the balance sheet, you should not directly write down the amount of bad debts. First, what we have to do, you need to deduct the bad debts from sundry debtors. And the balance is shown under the current assets, like depreciation. We will deduct the depreciation from fixed asset in balance sheet. Like that here also, bad debts are deducted from sundry debtors and the balance is shown under current assets. Clear? Now let's see the example. Sundry debtors are rupees 50,000. Sundry debtors are rupees 50,000. Out of this 50,000 rupees, 2,000 rupees is irrecoverable, not able to collect from the customers. Now this rupees 2,000 write down in the debit in the profit and loss account as bad debts, that is rupees 2,000. Clear? And after that in the balance sheet, sundry debtors, it will be shown as rupees 48,000 in the balance sheet, means 50,000 minus 2,000. 50,000 minus 2,000 means in the balance sheet we need to write down the amount of rupees 48,000. That is shown under current assets. Why? Because sundry debtors are current assets because they are amounts receivable within a short period. Clear? When a debtor becomes recoverable, that amount is called as bad debts. Here in our example, the amount irrecoverable, that is rupees 2,000. So bad debts that reduce the value of sundry debtors. Here actual sundry debtors are 50,000 but bad debts are rupees 2,000, means the amount shown in the balance sheet as sundry debtors is rupees 48,000. Means bad debts reduce the value of sundry debtors. They are shown by deducting from the debtors under current assets. Clear? Easy, right? So treatment of bad debts are, first we need to shown in debited to the profit and loss account as bad debts because it is a loss, and after that in the balance sheet bad debts are deducted from the sundry debtors and the balance is shown under current assets. Clear? No, so in today's class we learned three adjustments. They are, first one, it is income received in advance. Income received in advance. First we need to deduct from the income in the profit and loss account. After that shown as current liability in the balance sheet. And second one is depreciation. First we need to debit it to the profit and loss account. And in the balance sheet, depreciation is deducted from the value of asset and shown on the asset side of the balance sheet. And bad debts. First, we need to debit it to the profit and loss account. And after that, bad debts are in the balance sheet. They are deducted from the sundry debtors and the balance is shown under current assets. Clear? So these are the three adjustments of financial statements. So I hope this class is clear to you all. In the next class, I will continue this financial statements with adjustment class only. Clear? If you have any doubts in this class, please leave a comment. Thank you.